What is a central bank digital currency, CBDC? Central bank digital currencies are digital tokens that are issued by a central bank and resemble cryptocurrencies. They are linked to the value of the fiat money used in that nation. CBDCs are being developed by several nations, and some have even put them into practice. Understanding digital currencies and what they signify for society is crucial since so many nations are looking at how to make the shift. Government-issued currency known as fiat money is one that is not backed by a tangible commodity like gold or silver. It is regarded as a type of accepted legal money for the exchange of goods and services. Banknotes and coins served as the traditional forms of fiat money, but technological advancements have made it possible for governments and financial institutions to replace the physical form of fiat money with a credit-based system in which balances and transactions are recorded digitally. Although physical cash is still extensively recognized and exchanged, its use has significantly declined in several wealthy nations, a tendency that increased during the COVID-19 epidemic. Digital currencies in cashless societies are becoming increasingly popular as a result of the development and adoption of cryptocurrencies and blockchain technology. As a result, central banks and governments all over the world are looking into the use of digital currencies that are backed by the government. These currencies, like fiat money, would have the full trust and support of the government that issued them when and if they are adopted. Numerous people lack access to financial services both in the United States and in many other nations. Only 5% of individuals in the US do not have a bank account. Another 13% of American people utilize pricey alternatives like money orders, payday loans, and check cashing services but still maintain bank accounts. The basic objective of CBDCs is to offer financial security, privacy, transferability, simplicity, and accessibility to companies and consumers. CBDCs may also minimize the cost of cross-border transactions, lessen the expense of maintaining a complicated financial system, and offer more affordable choices to those who now move money via other ways. There are two different kinds of CBDCs, wholesale and retail. The main users of wholesale CBDCs are financial institutions. Retail CBDCs are utilized by customers and companies in a manner similar to that of tangible forms of money. CBDC wholesale transactions resemble keeping reserves at a bank. An institution receives a bank account from the central bank to deposit money into or utilize to complete interbank transactions. Then, central banks can control lending and set interest rates through instruments of monetary policy like reserve requirements or interest on reserve balances. Retail CBDCs are digital currencies supported by the government and utilized by both consumers and companies. Retail CBDCs minimize intermediary risk, or the possibility that private digital currency issuers could go out of business and forfeit the assets of their clients. Retail CBDCs come in two different flavors. How each user accesses and uses their money varies. With private and public keys, one may access token-based retail CBDCs. Users can carry out transactions anonymously thanks to this validation technique. In account-based retail CBDCs, accessing an account requires a digital ID. Wholesale and retail CBDCs do not compete with one another. Both may be created and made to operate in the same economy. A CBDC removes the risk to third parties from occurrences like bank runs or collapses. The central bank is responsible for any remaining systemic risk. Reduced complicated distribution networks and more jurisdictional cooperation between governments can minimize high cross-border transaction costs. The most widely used currency worldwide is still the dollar. A US CBDC could defend and maintain its hegemonic status. Removes the expense of setting up a financial system in a nation to provide the unbanked populace access to the financial system. By creating a direct link between customers and central banks, CBDCs can do away with the need for costly infrastructure. The United States financial system may undergo significant transformation. Unknown are the effects that a change might have on consumer spending, investments, banks' reserves, interest rates, the financial services industry, or the overall economy. It is uncertain what impact a change to CBDC might have on the stability of a financial system. For instance, during a financial crisis, there could not be sufficient central bank liquidity to enable withdrawals. Monetary policy is used by central banks to affect spending, lending, interest rates, inflation, and employment rates. Central banks must make sure they have the resources necessary to have a beneficial impact on the economy. One of the main motivations for cryptocurrencies is privacy. In order to monitor CBDCs for financial crimes, authorities would need to interfere with them in a way that is appropriate. Monitoring is crucial since it aids in the fight against money laundering and the funding of terrorism. Cryptocurrencies have been the target of criminals and hackers, as has been shown on several instances. The same kind of thieves would probably flock to a central bank-issued digital money, thus major efforts would need to be made to thwart system infiltration and asset and information theft. CBDCs versus cryptocurrencies. The ecosystems of cryptocurrencies offer a glimpse of a different type of monetary system where transactions are not subject to onerous laws. They are difficult to copy or forge, and they are protected by consensus processes that thwart manipulation. Bank of America digital currencies may not need blockchain technology or consensus procedures, but they are intended to be comparable to cryptocurrencies. Cryptocurrencies are also decentralized and uncontrolled. Their worth is determined by user interest, use, and investor reaction. They are speculative. CBDCs are not cryptocurrencies, despite the fact that the concept of central bank digital currency is inspired by cryptocurrencies and blockchain technology. While cryptocurrencies are usually decentralized, meaning they cannot be governed by a single authority, CBDCs are managed by a central bank. There will be no US CBDC as of March 2022. However, the Federal Reserve and its divisions are looking at CBDCs and how to integrate them into the American financial system, and President Biden has mandated the creation of a national digital currency policy. Blockchain need not, but it is an option for CBDCs. In their research, the Federal Reserve Bank of Boston and the Digital Currency Initiative at Michigan Institute of Technology discovered that distributed ledgers may impair a CBDC's effectiveness and scalability. Thank you for watching. Please like, share, and subscribe.